Hey everyone, I'm here to help you learn accounting. Many people assume accounting is a math. Well, accounting is not a math. First of all, let's be clear on that. Even though accounting uses a lot of numbers, accounting essentially is a systematic way to collect, record, and store financial data. We analyze the data, and in the end, the financial information will be presented to the management for decision making. Just like individuals looking at their financial information rely on it to make personal decisions, such as buying a house, investing in the stock market, or even switching to a higher paying job, companies rely on financial information to make business decisions, even though the information is a summary of the past events. It is still important to know the financial status of the company to forecast for the future. There are many types of entities out there. Let us first talk about different types of entities. U.S. Small Business Administration defines a small business is a business that has fewer than 500 employees. They reported that 31.7 million small businesses in the U.S. and roughly 20,000 large businesses. 81%, roughly 25.7 million small businesses have no employees. They're called non-employers. On the website, we identify this table showing us the type of businesses and the business structures. Business structure refers to the legal structure of the organization under a given jurisdiction. Let's start with the sole proprietorship. From the table, it's easy to tell that for non-employers, 86.6% are sole proprietorship. Let's start with this type of entity. Sole proprietorship is a legal business structure that only has one individual who is the owner. It's a simple list business structure. Freelancers, plumbers, and piano teachers all fall into this category. Sole proprietorship is not a separate legal entity from the owner. The business is required to file tax return with the owner's individual tax return. It is easy to form and costs very minimum money. You do not need to file any paperwork with the state agency or open a business bank account. You don't need to do that. You can roll up your sleeves and start doing it. And then let's talk about the dislikes. As you all know, the owner of the sole proprietorship, they have unlimited liability for the owners. So that means the owners are responsible for all the business liabilities. So their personal assets might be at risk. So when you form this type of entity, you want to be careful about this downside of the business structure. Move on to the partnership. A partnership is a legal business structure that is formed by two or more partners. Each partner can contribute the partnership, the capital, the property, labor, or services. Little paperwork is needed to start a partnership. You just need a partnership agreement. Even though the partnership agreement can be verbal agreement, but we always suggest put in the writing. Different partners contribute different knowledges and expertise to grow the business. This is very important. And also partners share the financial burden because different partners contribute different things in there, including the money. So the owner does not have to be the only one to share the financial burden. It's shared by every single one of them. Some of the dislikes, including, this partnership is not a separate legal entity, and the general partner of the partnership has unlimited liabilities. It sounds scary because nobody wants to have unlimited liabilities or expose their personal assets. And the control of the company is not just by one person, it's shared between different partners. Corporations. Corporations is legal business structure that is formed by one or more shareholders. It's a separate business structure. Many big corporations such as Walmart, Apple, Facebook, and McDonald's are C corporations. The reason business owners favor this business structure because it is a separate legal entity. A shareholder has limited liability. It is easy to transfer ownership. For example, for a non-public company, the board of directors approve the ownership transfer, and the secretary just documents the transaction properly. Unlike a partnership, when there is a change in the partner, the partnership comes to an end, and the corporation has perpetual existence. C corporation is much more attractive to investors than the partnership or LLC. Obviously, the downside is double taxation. What is double taxation? Double taxation means that C corporation pay income tax on its profit. When the corporation pays the dividend to the shareholder sometimes have to pay personal income tax on dividends. Depends on their individual tax situation. Another disadvantage of this C corporation structure is C corporation is much complex to manage than other types of entity. And C corporations have to follow certain rules. For example, an annual board meeting is required, and the minutes of the meeting have to be kept properly. The type of entity we want to discuss is limited liability company. A limited liability company is a business structure followed state statute. Most states do not restrict ownership, so member may include individuals, corporations, or other LLCs, and foreign entities. There is no maximum number of members. Most states allow single-member LLC, so that's equivalent to the sole proprietorship. And those entities only have one owners. Some of the benefits including, it's a separate legal entity. Also, the members have limited liability. And the LLC has flexibility to be taxed as sole proprietorship, partnership, C Corp, or S Corp. Some of the dislikes are, the owners cannot be employees. Owners are owners, employees are employees, and ownership can be really spread out. Well, this is what we discussed today, different type of entities. If you have any questions, or have any topic you are interested in, leave a comment, and we'll work together to figure it out. Thank you. Bye.